Hi everyone, it's David Pryor from Priority Funding and Forward Funding. Today we're going to start a series of videos specifically talking to accountants and their clients regarding what sort of funding facilities we're able to provide to help accountants with their clients, but also clients to acquire equipment, unsecured loans, debt consolidation, all those sorts of things. So today's video, we're specifically going to talk about debt consolidation. The tax department, as of 2025, are now noting that you cannot claim your interest of any tax debt against your business. You can't claim it as a tax deduction. So many clients are looking for better, more efficient ways to actually fund the tax debt and other debts that they may have. Now, your typical debt consolidation, the cheapest possible method is obviously against your property, first mortgage against your property, and that will be typically at home loan rates if you have the time available to do that. Depending on what profile you present to the lender, you may be in business enough time, you may have a good credit rating, you may have good turnover that you can actually declare via tax returns, all those sort of things. That's your typical standard mortgage. You can borrow up to 80% LVR or 80% of the property value against the property. And many people are using this facility to actually pay off their tax debt, pay off other debt, other expensive money, get cash back going through the business, all those sorts of things. The second one, which is similar, is what we call a self-declaration, an accountant's declaration loan. It too attracts great rates in the sixes at the moment, as of June 2025. And effectively, it is you declaring that you're earning XYZ per month or per year, and the accountant verifying that via a letter. Sometimes they'll ask for a BAS statement or some other verification, but it's effectively a self-declaration product. Slightly higher interest rate, less funders who do so, but also can lend up to 80% of the value of the property. Again, a very good facility. Either of these first two facilities take anything up to 6 to 8 weeks to do, so they do take longer. If you're needing funds quickly, if you're needing them within, say, 5 to 10 working days, there are private lenders available. Effectively, I call these the solicitor fund type transactions. And depending whether it's a first mortgage or a second mortgage, they attract different rates. Typically, a first mortgage will attract around about a 12% interest rate, or second mortgages anything up to and above 2% a month. What we do with those facilities is we actually arrange facility and arrange an exit clause within 3 to 6 months, allowing for the self-dec or other tier one lend to take this funding out within 3 to 6 months. Again, you only do the private or solicitor fund transaction if you're needing fast funds, or if your current status, whether it be credit, whether it be cash flow, whether it be bank statements, poor history, whatever it may be, you may be qualify to do the solicitor's fund transaction, and then once everything's settled down, move into a tier one transaction. Typically, with these solicitor fund transactions, you have an interest rate which you can actually borrow then your interest only facility for up to 6 months. So let's say you're paying $1,000 a month, you can actually borrow that $1,000, so you're not paying it per month for 6 months to help you cash flow wise. And then there are typically anything up to approximately 6% worth of fees up front, which includes the brokerage fee, the arrangement fee, the solicitor's fees, any other processing fees. Yes, it's expensive, but it can be done in 5 to 10 working days. This is a very good facility to borrow up to, say, 70% LVR against the property, and you can get rid of tax debt, you can get rid of bills that you are struggling to pay, so that can be council fees, it can be credit cards, it can be any debt for your business. All of these facilities are business-orientated debts and allows you to clear up that cash flow as we spoke about. With debt consolidation, sometimes we can use chattels or equipment within the business as well. So I'm doing a transaction at the moment, it has a $90,000 car and they want $50,000. So we're using the car as security and arranging $50,000 against the car. This can be done. It's a little bit harder than property because obviously property has a much viewed to have a much higher value than other chattels and equipment. Very quickly, that is the logic behind debt consolidation. It's fantastic if you use it properly. We don't put people into bad debt if we can help it. So we try and put them into a facility which will help them to grow their business, pay off debt, improve their cash flow, and then transition them into a better facility long term. This is the first of a number of videos on talking to accountants and their clients. So I look forward to seeing you in the next video.